As we go through accounting changes and error corrections, keep this chart in mind, right? We've got three types of changes that we will see. Now, these are changes in accounting principle. What do you do if you change your accounting principle? What do you do if you change your accounting estimate? So changing number, right? Change the estimate of how much a number should be reported on your financials. And then what about a change in reporting entity? So if we go from being a consolidated entity to splitting up, or maybe we merge together, mergers and acquisitions, all three types of changes have different treatments. Let's start off with a change in accounting principle. Well, this is a change in one GAAP with another GAAP principle. So, for example, adopting a new FASB standard. Maybe we adopt the new lease standards, or we adopt a new change. Maybe we change inventory between LIFO, FIFO, and weighted average. Maybe we transition from using the fair value method to the equity method. Or maybe we change from using the completed contract method to percentage of completion. All of these are going to be items that you see throughout the rest of the exam. Now, what do we do with those? We'll talk about that after. Just want to start with this, examples of each. Changes in accounting estimates. So this is going to be when you revise an estimate because of new information or experience. Maybe you switch depreciation methods, which changes your estimates, which changes your dollar amounts, because now you know that one is more accurate for your PP&E. Maybe you change the useful life of your depreciable asset because it makes more sense, because you realize it's going to last longer. You change the residual value of your depreciable asset because you realize that the salvage value, which is the same thing as residual value, you realize that it's going to be much more or much less than you had originally estimated. Maybe an estimate in the change of the bad debt percentage. You expect that you're going to collect more receivables than you thought you were going to. Lastly, change in actuarial estimates pertaining to a pension plan, another estimate change. Also, another common we'll see in contingencies and commitments, you could also see a change in the estimated liability of a lawsuit, of the lawsuit outcome. Now, as I mentioned, the change in reporting entity, this is going to be the change from one type of entity to another. So maybe we go from just one entity to consolidated financial statements, or maybe we break up the subsidiaries. So that's basically what's going to be in our change in reporting entity. All right. Just a note here that accounting errors are not considered an accounting change. So there really are four categories here, but the fourth one is just accounting errors, and that's not considered an accounting change, and you just correct the error when you recognize it, right? It's not going to be much fancy things to do, just like with these.